This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today we continue our series of growing the value of your business. And I've titled today's episode, Understanding the Cost of Capital and Risk Relationship. You know, like I always do, I start off with a story or something that relates to the topic. But before I do, let me explain. Today is a pretty heady type of conversation. It's one that I could present pretty easily in front of a room because you would have slides, but verbally through the podcast or on a YouTube channel, it's a little bit more tough to deal with. So I'm going to do my best, and I'm going to say that I'm going to reference many different scenarios today and different facts that we're going to include in the blog post. And so today is episode number 67 on the blog post, and I challenge you to go over and look at the Financially Simple blog to look at the details. But, you know, in my last podcast, I introduced you to Jeff. And as a brief refresher, you might remember that Jeff was a pretty successful business owner who had an extremely profitable business, but his business was virtually worthless. Yeah, he's making a lot of money, but the money wasn't of value to someone else who would pay him for the business. He had built a company with enormous amount of risk and various risk, even though it was profitable. See, if you remember, Jeff had reinvested all of his profits into the company, which he hoped that someday he could sell this concentrated position of a business for a profit. He had all of his eggs in one basket. And even though he had spent time building the business, he had made a few mistakes, some fundamental mistakes. He had spent most of his money purchasing equipment, and then he depreciated the asset or the equipment, and it wasn't as valuable as he expected. The equipment had lost value. And then once he did sell the equipment, the recapture tax would just eat his lunch. So, you know, he had $2 million of equipment, and if he sold it, his walkaway money would be about $300,000. Now, Jeff is not alone in his decision making. Many times I hear business owners, especially at year end, say, I'm going to purchase some equipment for my tax benefits. You know, a good tax advisor will tell you, look, don't go out and just buy equipment or buy things just to reduce your taxes. Now, a good tax advisor will say if you need the information for business, and they often categorize that need, if you need it, then go ahead and let's make the purchase. But many times cash could be deployed somewhere else or elsewhere in the company, which could result in less risk or a de-risking of a company. It begs the question, how do we understand how to make those decisions? Where do we deploy our cash? And how do we identify what areas of our business will the cash help us the most? I mean, I could sit here and ask questions all day long about how we could deploy cash, but the starting point on the journey of building the business value and understanding how to deal with the day-to-day operations centers around this topic of cost of capital. Cost of capital. You know, when I entered the financial world and started understanding this, I didn't know the terms, but I knew the concept. And the more I deal with business owners, very few business owners understand the terms, but we work in the concept quite often. But I want to deal today with what is cost of capital and how specifically does it relate to risk and why does it even matter in the area of growing value in our business. So first, let's define what is cost of capital. According to several different sites, and I'll put this one online for us, according to one source, it says cost of capital refers to the operating cost of making a specific investment. It is the rate of return that we could have been earning if we put the money somewhere else or into another investment of equal risk. Thus, the cost of capital is the rate of return required to persuade the investor to make a given investment. Now, that's the technical definition. That's the textbook rule. But how does it play out in our business? So let's go back to Jeff, and I'm going to oversimplify a very complex problem, but let's assume Jeff had a profit in his company of $100,000 in a given year, and he wanted to reinvest the money in his company versus taking the $100,000 out as income and thus increasing his tax bill. So he just wanted to reinvest. He wanted to create an expense within the organization or buy an asset which was able to be depreciated. So he wasn't taking the money out. We have $100,000. He's going to use it in the business. Now, let's say Jeff has been eyeing another piece of equipment, because that's kind of the premise. And I'm going to put air quotes up here. He just needs this piece of equipment, right? So Jeff does his best to calculate that this new piece of equipment would generate him roughly a 20% net profit return. So in other words, the piece of equipment would give Jeff roughly $20,000 additional profit per year. Whenever I say profit, I'm saying that the expense of the $100,000 will actually add to the net revenue, the net income of the company, $20,000. So that'd be a 20% net profit return. Now, Jeff realizes he also has the ability to invest the money in another asset. Let's keep it super simple and say he puts it into a bond, like a security, something that is issued by a company. And the bond would yield Jeff 5% or $5,000 a year. So in a simple comparison, you and I would easily say that Jeff would be better served putting the money into the equipment that would yield him a 20% return versus deploying the money to a bond that would yield him a 5% return because of the $15,000 greater return. Thus, 20% of $100,000 is $20,000 minus the 5% return of $5,000 gives us a $15,000 difference. Now look, this is an ultra simple comparison. And Jeff would be better used in this ultra simple comparison by deploying his capital into the equipment because of the better return when we outline that. However, there's a caveat. We have to look at risk in our cost of capital equation. And this is where many business owners fail. This is where our value is often harmed. Now, we already know, talking with Jeff, that if he bought another piece of equipment, he's just pouring gas on the fire. He already has a graveyard of equipment that he can't hardly sell for what it's worth. And if he does sell it, he's going to get hit with recapture tax. So buying another piece of equipment is just pouring salt on a wound. It's not good. But when we start looking at the risk scenarios, we start asking questions like, and these are some basic questions. Is there another area of the business which could yield a better return than this equipment? See, many times we'll look at, in Jeff's case, of going out and buying another piece of equipment because it's sexy. He can see something, it's shiny, he can touch it. But yet there could be another area of our business that we could deploy this capital toward that would give Jeff a better return. So that's one question we can ask. We can also ask the question, what risk are we adding by purchasing or deploying this cash toward the purchase? So whenever we add another piece of equipment, we have risk. Are we increasing the operating costs of the company? Are we increasing employee costs? Are we increasing insurance costs? Are we increasing transfer costs or moving the equipment from one job site to another? So inevitably, there's types of risk that we're increasing. You know, the biggest question is, are we de-risking the company or adding risk? Is this particular purchase going to de-risk the company? And we're going to nail down what de-risking is. So just keep that in your mind. I'm introducing that term now because we're getting ready to jump into that. Another term I'm going to introduce here is, what are our company-specific risk, and is this purchase reducing that company-specific risk? So I've just introduced two terms to you as we're dealing with this cost to capital. One is de-risking and one is company-specific risk. And I'm going to put those out there so your mind can hear those now, and we're going to come back and deal very thoroughly with those here in just a few minutes. So why does understanding the cost of capital even matter? The reason for it is cost of capital is a key component in business valuation. So whenever you go to a valuator who's going to look at the details of your business, they're going to use a cost of capital calculation within the appraisal to actually stand or actually surmise what they believe the value of the business is. Because cost of capital is a key component in business valuation. Look at it this way. An investor who might be willing to invest in your company, they want their dollars that they're investing to grow. And they are actually calculating their own cost of capital as it relates to your specific company. So they're saying, look, if I put down $100,000 or $1 million or $10 million for this company, is my whatever number is, 100, a million, $10 million, is it giving me a cost of capital that is lower than my current cost of capital I can deploy somewhere else? In other words, is it going to be a better investment? In similar fashion, the investor looking for their return on investment, as you are whenever you say, how am I going to deploy this money within my company? See, you and I'm going to give you an example of cost of capital and try to help you bring this risk home. You and I often hear companies on the news like Apple versus Samsung. We hear them in trade wars. We hear Burger King versus McDonald's. We hear Walmart versus Target. And sometimes we even make these same analogies. We'll say Apple versus Samsung. I've often alluded to that on the show that, hey, I'm an Android guy, so I'm a Samsung guy. And then I get hate mail or hate tweets, which is cool. I love it. I love it. Bring them on. And I'll challenge you and I'll continue to say that Androids are for smart people. I'm just joking, but not really. No, I'm joking. Not really. So you Apple folks, go ahead and shoot me some nasty grams. Just don't use profanity. My children were reading my Twitter the other day, and I was like, dude, that's not cool. Anyways, shoot me a tweet and tell me, dude, Justin, go ahead and get you an Apple and meet Jesus. No, seriously though, in a public company, something like an Apple or something like a Samsung or McDonald's or Burger King or any of these publicly traded companies, there are systems in place and checks and balances and measurements and regulations that are set forth to help reduce the risk to the investor. So these publicly traded companies have all sorts of checks and balances and systems to help reduce our risk if we invest in these companies. Now, before I go any further, as the Chief Compliance Officer of a registered investment advisor, I am not telling you to go out and buy any of these aforementioned companies. That is not what I'm talking about here. I'm just using their names as an example. This is not a recommendation to buy any type of security. So let me just lay that out there. I have to deal with that as a financial advisor. No, I'm just giving you these companies as an example. And so let me drive it down for you. All the companies are publicly traded companies. They must comply with a law or an act, which is called the Sarbanes-Oxley regulation. And in the purest and simplest definition, so my CPAs are going to tell me, dude, you just butchered that. But I'm going to simplify it in the way I think of Sarbanes-Oxley. The regulation is an attempt to uniform the financials of a company for transparency. That's what the idea is to try to make everything similar so that investors can see what's happening in the actual organization. However, many small businesses like mine, I don't have to comply with the Sarbanes-Oxley Act. Thus, for the potential investor, someone who's looking at trying to buy my company, there are unknown risks in my financials. My financials could be off. My projections could be off. My guidance of my company could be off. And because it doesn't apply with the Sarbanes-Oxley Act, it's perceived a greater risk. So the greater the risk, the lower the value. I hope that makes sense. So the big companies out there, they have systems in place to help them de-risk or reduce their risk.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
Another thing that happens between big companies and our companies is there's a size difference between a publicly traded company and my business. Yeah, I do not have as much cash as Apple. If I did, I'm not sure I would be in business today. I think I'd be sitting on a beach somewhere or hiking some mountain somewhere. But I don't have as much cash as Apple in my organization. And so because I am at a size disadvantage, I theoretically do not have the same sustainability. And that's a big word. I don't have the same ability to weather the storms as theoretically Apple should. So again, whenever I'm looking at size of the company, a company like mine whose size is smaller than maybe a middle market company is not going to have the same value because I have greater risk involved in my organization. So let me try to explain this a little bit better. There's a study done by pepperdine.edu, and I'm going to put this on the blog post. Pepperdine outlines the cost of capital or risk of private companies versus public companies. And they've identified companies at about every stage of the spectrum. So whenever I say every stage of the spectrum, you can start off with angel investors. Those are startups. Venture capitalists are companies that are moving a little bit and somebody invests in them to help them give them a shot of energy in the arm, so to speak. You have private equity. You have mezzanine investing, asset-based lending, and bank lending. Those are the basic areas or the stages of capital in an organization. And so I'm looking at a chart here in front of me, and I'm going to try to explain this as best I can. On a startup company, like an angel investing, there is a capital market required rate of return before somebody will invest in the organization. Because, for example, startups, they have, according to the study, they have a range of 35% return on investment to 60%. So that's what the capital markets say before a private investor will buy or will give money to an angel or a startup company. They're expecting a 35 to 60% return on their money. So in effect, many times people will not invest in startups because there's a risk of default. And so angel investors do their best to make sure that the business plan, things of that nature are in place to drive long-term profitability so that they can get a 35 to 60% rate of return on their money. Now, because a startup business is much more risky than maybe a business that's already funded, where venture capitalists would be, your startup is expecting a 35 to 60% return, whereas a venture capitalist is only expecting about a 25 to 35% return on the money. So they buy $1 million, they're expecting to see $250,000 return from their money that they've invested. And as you move from infancy, like a startup business, to maturity, like a publicly traded company, along each one of these spectrums, the rate of return decreases. The reason why it decreases is because the risk decreases in nature. So here are the numbers. For angel investors, and again, this is according to the Pepperdine study on capital market required rates of return. So for angel investors, the people who invest in angel startups, they expect roughly 35 to 60% return on their money. Venture capitalists are between 25 to 35. Private equity is between 20.5 to 27 roughly. Mezzanine investing is 10% to 24%. Asset-based lending is between 5.5 to 14, and then bank lending is 4 to 6.5. Bank lending is typically large companies. All of this that I've just described comes to one simple scenario. The study reflects that private companies cost roughly 3 times to 5 times more than public companies. And as we talked about earlier, it could be size, it could be capital, it could be a number of things. But the higher the cost of capital, the lower the business value. So if the cost of capital angel is between 35 to 60, then the value of a business in its infancy or in the startup phase is very small. There's really no value there. Versus a company that's publicly traded that may be, 24, 35 to 1 price per earnings ratio, that's going to have a larger value. The reason for that is, as the Pepperdine study reflects, that 2/3 of the value difference is related to specifically company-specific risk. So let me restate that one more time a different way. The Pepperdine study reflects that 2/3 of the difference in value between the angel on the far right side of the chart to the far left side where publicly traded companies are is directly related to company-specific risk. So that leads, the question is, what is company-specific risk? Well, before we jump on that, you have to understand that company-specific risk is the key. There can be several companies within the exact same field, and one company has a higher value than another. In fact, the chart reflects that. It actually gives what's called first quartile, median, and third quartile returns. And you'll notice between the first quartile return and the third quartile return of the chart. And again, I'm going to recommend you go look at the blog post, but you'll see that even companies that are within the same exact scenarios, the exact same field, one company could have a higher value than another. Now, we dealt with that a little bit in the last episode when I was talking about company A and company B and how one company didn't really invest anything in the organization and company B had like top-notch team, top-notch equipment, they had good training, etc. And we looked at those, and all things being equal, many times the investor will invest in a company that has a higher value that's not focused solely on profitability. They're focused on long-term sustainability. So I'm going to make a statement here, and I want you to stick this like a feather in your cap and remember this throughout this entire series. The ultimate goal of driving the value of your company is to reduce the specific company risk of your organization. Let me say it again. The ultimate goal is to reduce your company specific risk. So that leads to what is company-specific risk? It's just what it sounds. I'm going to read a definition, but it's exactly what it sounds. It's the specific risk is a risk that affects a minimum number of assets. Specific risk, as its name implies, relates to the risk that is a very specific to a company or a small group of companies. This type of risk is the opposite of overall market risk or systemic risk. Specific risk also referred to unsystemic risk or diversifiable risk. And so that goes to various things. So I'm going to give you 10 real quick ones. These are fast. These are not all. So various risks could be one company could have operational risk. Maybe there's operational inefficiency compared to another that is very efficient. One company could have systems risk. There could be risk inside the organization as relates to their systems. I see this one often. Maybe there's a customer concentration risk where a majority of the revenue that your company is receiving comes from one customer. That's a risk. Maybe there's a quality control risk. It could be an equipment, a sales, a profitability risk. It could be sustainability. How can the company weather the storms? Is it positioned for downside storms? Maybe it's predictability. And that's just a simple scenario. Maybe it's market risk. And those are just a few. Now, as we go forward throughout the series, we're going to start dealing with the 8 core areas of business and de-risking. In other words, moving company-specific risk out of our businesses could engage as many as 256 different areas of your business. There's a ton of different areas that you could de-risk. The focus of increasing the value of the company is centered around reducing the risk of the company. And in all episodes of building value, the goal is to reduce risk and increase value. So as I mentioned before, the goal of growing value in your company is to reduce risk. In the reducing risk of your company, the cost of capital decreases. Remember, you're moving from the right side of the chart to the left side. You're moving from an angel investor all the way, hopefully, to a mature company. And as you do that, you're reducing your risk, theoretically. And by reducing your risk and decreasing your cost of capital, you're adding value to your business. Whew, that's a lot of information, folks. It's not going to always be this difficult. I'm doing the best I can to break something down. So simply put, we have to reduce the cost of capital. We have to look at, from an investor standpoint, what risk do we have in our organization and how can we streamline our company so if an investor looks at it, they can identify the risk and be able to offer a higher price for us. So with that, I'd like to thank you for joining me on the Financially Simple podcast. As I mentioned several times today, go check out Financially Simple on the heading podcast. This is episode number 67. And look at the charts I'm referencing today. Hey, while you're on the blog, feel free to sign up for the weekly newsletter. Every week, I release tax tips, business planning tips, wealth management tips, and so much more. And if you like the podcast, please subscribe, leave me a review, share the podcast with other business owners. You know, we're trying to increase the value of businesses. I'm so tired of watching business owners work their whole life, folks, for a good business, only to watch it just dwindle away. Their dreams dashed against rocks. I hate that. So like I say every week, life is hard. Business, it can be fun sometimes, but life is good. Life is good. And life can be frustrating. Trust me, I know. Money doesn't have to be. Let's continue to make our lives financially simple. Hey, y'all go out and make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.